Sydney's debt sheep are scrambling like rats. Martin North, John Adams, in the interest of people. John, you come up with some amazing titles, but this really takes the biscuit.
Hi, Martin. How are you going today?
Pretty good.
Excellent. So in the last few shows, Martin, we've been talking about how rapidly things are moving along. And we've obviously did what we did in our last show is talk about how a number of central banks have surrendered the fight to inflation. And yet Australia hasn't sort of done that yet. So we're still talking tough. Only in the last 24 hours has the RBA governor said that on the 5th of July, we're looking at either a quarter percent or a 0.5% increase in official interest rates. And one of the interesting things about today is ANZ has raised their fixed rates by 0.9%. So we are seeing some very dramatic moves in interest rate pricing, both at the short end of the curve around variable interest, but also in terms of fixed interest. And just to give you a sense about some of these movements in interest rates, I mean, last November, December, a mortgage borrower could borrow at a 5-year basis around 2.5%. And as of today, ANZ is saying if you want a 5-year fix, it's 6.5%. So just on that one scale alone, we're looking at already at a 4% increase. And again, so when you're borrowing in the biggest bubble in Australian history, these moves are having significant financial impacts right throughout the economy.
And just another way of looking at it, John, which I've been looking at, is the so-called borrowing power. In other words, for a given level of income, how much can you borrow? The borrowing power compared with last October, November is down now between 15 and 18% for most households. So in other words, people just can't get the bigger mortgage that they used to because, of course, the rates have gone up, and so the affordability is just much less now.
Yes. Now, just so I'm consistent with what we've done in the last few shows, I am still suggesting that they are going to raise rates to a point where the pain becomes too much, then they will pause, and then they will reverse course. So that hasn't happened yet. I mean, the markets are basically saying it's going to be the official cash rate could go up to about 4% by the end of the year. So it's a dramatic rise up. The RBA saying we are going to go all the way until we get inflation under control. And there's no sense of a pivot. But what I want to really cover in today's show is how will we know that the pivot is coming? And so what we need to be looking at is forward-leading indicators as to how severe is the pain. So they will inflict pain. So the marginal borrower, as the former governor said, Ian Macfarlane, or the late people to the party late around mortgages,
yep.
They're the ones who are going to be bankrupted. They're going to be sacrificed. And the establishment is willing to sacrifice a certain percentage of the market. But once that becomes too great for the system, that's when they're going to say we've got to slow down because we're not going to kill ourselves in the process. So there's probably a few key indicators to look at. We're going to focus on one today, which is very important. So some of the indicators that I think are important is consumer confidence, which we know from the ANZ Roy Morgan survey is at recessionary levels. In terms of the new housing market, new estates, new developments, etc. Now, there's a lot happening in that space, and we haven't covered that yet, so we want to cover that shortly. But also in terms of property listings, and that's what we're going to focus on today. And when it comes to property listings, there's going to be a couple of really interesting aspects as we go forward over the next 8 to 12 weeks. One is commercial property, and then obviously when it comes to residential property, there'll be those investors who want to liquidate their positions either because the cash flow of the property is not working in their favor or they don't want to be holding an asset that's falling in value. But also there'll be those owner-occupiers that are in financial distress and who'll be forced to sell because they can't afford the repayments. They can't afford the mortgage with the higher repayments. And so we're going to see some dramatic changes in listings. And one of the points that you and I discussed over the phone today was that listings is a better forward-leading indicator than credit, because particularly in a market like we have now where you have surging interest rates and you're going to have more sellers. There'll be more people wanting to sell than more people wanting to buy. Listings, what happens is people will list first before people go borrow money, and so listings happens at a process step before borrowing, and that's why listings is a more forward-looking indicator than credit growth.
Yeah, and it's worth just thinking about listings, because basically there are two things. There are new ones where people decide to put their property on, and there are existing ones that normally would get sold and therefore would reduce listings. So you've got those two forces, the up and the down. New ones coming in, things sell. So if there are more people listing new properties and less sold, then the total static count, as it were, goes up. And I think that's what we need to watch.
Yes. Now, what we're going to focus on today is we're going to look at some data from SQM Research, and we're going to focus on Sydney. Now, but not just Sydney. We're going to look at some of the surrounding suburbs, some of the surrounding regions around Sydney. So let's just put slide 1 on the screen. Now, the reason, Martin, why I think that some of these regions are important is because what we know, and particularly because we live in the Illawarra, so we have first-hand experience of this, is when the city market becomes too hot, like it did, say, last year, but also around 2015, 2016 as well. A lot of people from Sydney get priced out of the city market, and then they move to regions like Wollongong, the Blue Mountains, Central Coast, and Newcastle, and so you start to see a whole bunch of strong property price growth there. So it's not just that Sydney has the most expensive and overinflated property market in the country. Some of these surrounding regions have also seen tremendous price growth, and so as interest rates go up, we're going to see some pain, not only in the city market, but also in these other regions as well. Now, the other key point to make is that if we look at the daily index from CoreLogic, we know that the Sydney market was the first to peak, and it's the first one to start declining. So if we put slide 2 on the screen, what we can see, Martin, is that property prices peaked in Sydney on the 13th of February, according to CoreLogic. Now, Melbourne has also peaked on it was the 6th of March. The other capital cities have yet to peak and decline. So the first city in the country where we're going to really see this unfolding disaster manifest before the RBA says it's too much pain, it's going to be Sydney. And the way we're going to know how rapid that pain will be is in property listings.
And it's worth saying, of course, the CoreLogic index, as like all the others, is 6 to 8 weeks behind reality, right? Because it takes time for the settlements to flow through into the real numbers. So essentially what you're suggesting is that the fact it's tipping down, that's sort of going back 6 to 8 weeks, right? That's before any of the rate rises.
Indeed. So yes. So basically, what you're saying is that if property prices peaked in early February, we're talking potentially early December to early January as when the real peak happened, and there was a delay in the data.
Correct.
Yeah. Now. One of the interesting things, Martin, in terms of this SQM research is that it is collected at a particular point in time, and the data is collected at the first day of the month, and so what we tend to see is in a hot market, property is sold very quickly in say a 7 to 10 day period, whereas in a slow market, property tends to stay on the market a lot longer. So if you are taking a snapshot in time, what you will see is more listings happen in a slow market because they are not selling as fast. Whereas, for example, if you go, say, from the 1st of May to the 1st of June, you may have had a lot of properties being sold in that process, but they're not actually being captured in terms of this SQM research listing data. And so even though in reality there are more transactions and more listings in a hot market, the way the data is captured is actually an inverse relationship. And just to illustrate that, if we can put slide 3 on the screen. So what I've got here is the Sydney total residential property listings for going back to January 2010, and what we can see is that when the market is growing, because these properties are selling faster, the total number of listings on the market at the beginning of every month is going down, whereas in a market that is slowing or falling, the number of properties being listed per month are actually going up because they're not actually selling, and so that's that gives a bit of a sense as to how this data works and what these relationships look like.
And just to sort of re-emphasize it one other way, you can think of the listings number as effectively the stock of listings, right? At the point in time that they measure it, right? And there's new listings coming in, there's property being sold, but if it's a slowing market, the net result is more listings on.
Yes.
Whereas in fact, if things are being sold quickly, then the stock of listings drops.
Precisely, yes.
Yeah.
So rather than a flow diagram, so we're looking at the stock and not in terms of the flow.
Yeah.
If we start to go into, say, slide 7, Martin, and we just start to look at the Sydney region, so we can start to see there is a uptick in listings because of all these measures that we've just outlined. But obviously, again, this data doesn't include what the interest rate increases that happened in May, in June, and what we're going to see in terms of July. So if we just consider Sydney, listings are up in terms of houses and units together by 33%, and so we obviously see an upward trend. If we look at slide 8 and look at Wollongong. Again, Wollongong listings, and even though it's Wollongong, this data is more the Illawarra. It's up by 36.4%. If we go to slide 9 and we look at the Central Coast, quite a big jump there in terms of the number of listings, particularly for houses. It's up 88.2% from August to May 2022. If we look at the Blue Mountains, it's up 40%. Now, Blue Mountains property sector, that's a lot smaller in terms of the number of houses and apartments in terms of the market. And then if we look at the last region, the Hunter is up in terms of the number of properties listed by about 30.3%. So that works out to be about 1,200 properties. So we are seeing, Martin, that all of these changes that have happened in the May interest rate environment, that we've started to see this uptrend of a slowing market, and listings are going up.
Yep.
And these listings are obviously coming from an ultra low base because the number of these regions, it was in August of last year, it was the lowest ever. That was the low point. And so the real question here is, so we're seeing listings are going up, and this obviously started from August. We're seeing that property prices in February, according to CoreLogic, peaked and they're starting to fall. And so as we go forward, you're going to start to see this whole market unravel quite quickly. And so, yes, we're going to see fewer building applications, approvals. You're going to see, obviously, fewer new housing estates, and in terms of a major contraction in the building sector. But then obviously you're going to see fewer people applying for a mortgage, and obviously I've spoken to banks and credit unions here in the Illawarra, and they say November last year it was red hot. Yep. Everyone is coming through for a mortgage, whereas now it's dramatically slowed. Yep. And obviously, as we go forward, we're going to see a dramatic increase in listings because people, according to your own data, a lot of them are very stressed in terms of their finances. And the question is, how many of these people can hold on in terms of holding on to their mortgage? Because once people get into financial trouble, the only option is, and obviously this is something you've said in a previous show that we've done, that banks are really having conversations behind the scenes with certain people and saying it's time to list your property because we don't think you're credit worthy to be able to handle the mortgage. So I think all of these factors are coming into a state of play where a lot of these people who got themselves into way too much debt, they'll be trying to scramble like rats. they'll be trying to exit the market. And what we're going to see is a very dramatic increase in listings, and these properties won't sell. And the longer these additional properties come onto the market and stay on the market, that's going to have huge downward pressure on prices, and that's how it feeds into each other. And that's obviously what happened in Ireland.
And it's worth just saying, John, that property investors in Ireland ran for the exits first because they didn't actually think about it other than it's an investment, it's not working, and I'll sell it, right?
Yes.
Whereas those who own the property as somewhere to live, they were a bit slower. They tried to hang on and essentially, pared back their spending elsewhere first to try and actually just survive. But eventually it got to the point where they were unable to keep the property. So I think we're going to see similar things here. In fact, I would suggest that some of the early rise in listings that we're seeing are from those investors who've just said, no, it's not working now. No further capital growth in property for the next period. Cost of the investment property going up. Time to get out and capitalise on the capital growth that we've seen rather than just hang on. But I'm also watching now for the owner-occupiers who will take longer, but they are coming on stream too. And with the higher rates, we know that rates are going to continue to go up. That means we're going to see higher listings.